you ever heard of velocity banking? It is the ability to pay off a mortgage or pay debt at a very, very fast rate, moving forward and eliminating that debt ASAP. Now, in today's video, I really want to break down velocity banking when it comes in relationship to a mortgage and paying off a mortgage and show you exactly how this does work. Now, I was really skeptic at first, but looking at it, I can see kind of the ins and outs of how this could work, but I also see exactly how this can go tremendously wrong depending on your really time frame. So let's go break this down really step by step on how this works and how it could really happen when it comes to velocity banking and when it comes to paying off that mortgage. Now, step number one, taking out a mortgage. Now, if you're like me, $300,000 mortgage, 30 years is going to be at a fixed rate, let's say 3%. This means you're paying your lender $1,265 a month for 36 months. When you run the math on that, you are paying $155,000 in interest, even at a very low rate of 3%. So it's kind of crazy when you think of your mortgage at $300,000, if you're paying roughly 50%, that is right, 50, over 50% of your mortgage back in interest over a 30-year period. Now, when you start looking at this and thinking of that same $300,000 mortgage, now you're looking at 7%, the interest becomes astronomical, and the interest over 30 years actually becomes more expensive than the home itself. So you're almost paying your house for your house really twice. Now, looking at mortgages, they are relatively cheap. Thinking of the benchmark of a couple years ago, people are running about 2.5% to 3.5% mortgages. Now, rates, of course, if you think in the 1980s, we're around 18% for mortgages. So if you're thinking right now, even where rates are sitting today at about 7%, it's kind of incredible to think that the benchmark rates, again, where people are sitting when you look at the refinance from 2021, 2022 is about 3.5%, which is kind of crazy. Now, step number two of this is taking out your HELOC. So this is, of course, a home equity line of credit. This is better known, again, as that acronym HELOC. It's like a credit card on your mortgage. Now, this is where it has to be very careful because you are putting your home up as the collateral for this, and the debt is secured by your home. Now, typically, when people do HELOCs, they are doing home improvements, they're doing larger purchases. As it sits today, a majority of people that I see that are taking out HELOCs are doing debt consolidation, and that is what we're seeing. They're not doing this method to pay off the mortgage. They are focused in really building on consolidating credit card debt. Now, normally HELOCs have a much lower interest rate than credit cards. Right now, they're about 8.5%, where credit cards are at about 25%, but they are not completely risk-free. Now, the reason being, again, home equity rates right now are about 8.5%, I believe, as of this morning. So they are usually variable as well, which means if the Fed is lowering rates, the rate on the home equity is going to come down. If they're raising rates, which is what we've seen over the last couple of years, the rates are going to increase. Now, of course, this can make a lot of difference when it comes to velocity banking and really the math behind that, because lenders, they've been known to close off credit lines when the economy is bad. We see Bank of America do this. We've seen a couple institutions that actually closed down the credit lines in their entirety, regardless, and it went to a repayment phase only. Now, the step number three in here is using that HELOC to pay off your mortgage. Now, this is where the game really begins. Using that home equity line of credit to pay off your traditional mortgage. And like we said, instead of using the HELOC to renovate, using it instead of going on vacation, you are only using this HELOC called chunking to put larger deposits or larger payments on your mortgage itself. So if you're borrowing, let's say $10,000 from your HELOC, using it to pay the mortgage, now you're reducing that $300,000 balance we talked about down to $290,000, which means eventually over the time frame, you would save about $14,000 in interest on the $10,000 that you borrowed. And of course, it means paying off the mortgage roughly 18 months early just by doing it itself. Now, how? It seems like magic, but it is just math, guys. The interest on the mortgage is calculated on a monthly basis to determine how much you owe. The lender multiplies the outstanding balance, which would have been that $300,000, dividing it by 12. So the first mortgage payment, of course, is $1,265 with $750 going to principal, which is kind of crazy, or excuse me, $750 going to interest. And the remainder, the very small remainder, is going to principal. Again, even at a lower rate. As you chip away on the balance with your regular payments, the principal comes down, meaning that when you make your monthly payment, you're going to have more going towards principal, less going towards interest, as the principal or the mortgage itself does reduce the balance. This is called amortization, and you can speed it up by paying extra money which in the case is where the HELOC comes in. So step number 4, once you take that HELOC, you borrow that $10,000, you put it on the mortgage, you have to get your HELOC balance down to 0 ASAP. Now, the reason for this is HELOCs are really built a little bit differently. Now, paying on the mortgage with the HELOC, you're moving money from debt to money for debt. This, of course, can be a really big red flag for most people, but velocity banking, this is where the magic comes in. Because the home equity is revolving, it means you can pay it back, reuse it whenever you want to. Interest payments are calculated using the daily average balance, which means, like I said before, if you borrow that $10,000 on the HELOC, let's say during the month you make a $4,000 payment, you're only paying the remaining balance or the daily balance on the $6,000 that is remaining on that HELOC. Interest payments, again, are calculated on a daily basis. So when you start looking at Excel spreadsheets, when you start doing calculation, the lower the balance you can get it, the faster, the less you're going to have to pay for the HELOC, which we know is not true for the mortgage because it's only on a monthly basis. So whatever cash you have, every penny you have left is going right onto that HELOC balance and getting it as low as possible. To keep it lower for longer, I'm putting extra expenses in this again where credit cards come in. If you pay your credit cards off at the end of the month, you can go ahead and it will be interest-free borrowing. It is going to be 0%, which even the credit cards we offer as a financial institution, if they are paid in full, you pay a zero balance. So essentially now at this point, you're using your HELOC to chunk on the mortgage. You're using your HELOC to pay off your credit cards. So pretty much everything is falling back to that HELOC. And this, of course, leaves your credit card balances at zero. Everything you're putting on the credit cards, you can be accumulating points and some other perks. And guess what? You're never paying a penny of interest on that itself. Now, you have to be careful because if you game this wrong, if you shoot this wrong, if you're miscalculated, credit card rates are about 25%, which can be super expensive. So essentially, you're juggling 3 different things. Number 1, the mortgage. Number 2, the HELOC. Number 3, the credit card. That you're doing the financial side. It's the math side of it in the structure when it comes to the income. That can be really the big factor across the strategy. Now, the important things to remember or where this falls apart is number 1, you have to live well below your means. That is a super, super important part. If you're taking on excessive debt, there is no way that your HELOC is going to get paid off. There's no way that you're going to be able to pay off those credit cards time and time and time again if you're overspending. If the money that is going on the HELOC is growing faster because of the credit cards, because of the mortgage you're putting on there, then you can actually bring the balance down on a month basis. You're going to be in a very bad situation having a mortgage, having a high balance on a HELOC, and possibly having a credit card. That again, where people do fall into trouble. Now, the other one with this that really throws a wrench into it is depending on the difference between what you're paying for a home equity line of credit or that HELOC and what your mortgage rate is. Where for me personally, looking at a HELOC at 8.5%, looking at a mortgage rate at 2.5%, there is a very, very big disparity between there. So even breaking it down on a daily basis with what we'd be putting on a HELOC, very mathematically, it almost is at a break-even part with how much you're putting in there. That is super important to know. And of course, you need the mortgage and you have to have the equity to get the home equity line of credit. If there's no equity, you got no home equity line of credit. Financial institutions, most of them will only borrow 80% at a lower rate. You can go up to 90% of the home value at a higher rate, but of course, it is going to be at a higher rate. And again, that is going to make a big difference on how much you're saving. Now, for this strategy, like we said, the amount you owe on that line of credit needs to go down from month to month to the next month. You have to be living within your means. You have to be really cash flow positive for this to work. The only possibility is if you consistently spend less than you earn. That is the huge important part of this. So if you're a person with a $60,000 annual income, you want to save roughly 20 to 25% of that to make this work, to make the strategy mathematically work. And that is where I kind of caution you, because also remember, you are putting your home up as the collateral when you're doing velocity banking, when it comes to paying off that mortgage. Now, of course, when you start looking at some of the alternatives, what is the safe way to do it? It is putting extra money towards principal. That is the way that I'm doing it. That is the way that a lot of people are doing it. Then it really begs the question, do you put more money on the mortgage to pay it off early? Or do you invest that money? That again is set for another video. But when you start thinking of chunking, funneling extra money that is going onto that mortgage. You could look at tax refunds, bonus checks, stimulus checks, overtime pay, anything you're putting towards that mortgage. You wouldn't even have to worry about the velocity banking. You wouldn't have to worry about this big cycle of having the HELOC and the credit cards, everything else. And of course, you could go ahead and put 50, 100, $150 extra every single month. Even if you're saving 20% of your salary, a couple $100 on this mortgage every single month, you're going to knock it out way faster than you could ever imagine, guys. If you do some of the payment calculators, and make sure with your financial institution that there is no prepayment penalty for any of these. But when you start putting even an extra 50 or $100 on that mortgage, you're literally going to cut years off of that mortgage if you have a 30-year mortgage when it comes to really paying that off and getting it done. So guys, let me know what you guys think about velocity banking, paying off this mortgage, and the way that this really does work. Again, I was kind of fascinated by it, being in the financial institutions for almost 18 years now and being a financial counselor and educator. Wanted to know exactly how it works. And honestly, it can work, but you have to take it with a grain of salt because it can also go tremendously wrong if you're borrowing on a home equity, if you're borrowing to pay the mortgage. Let's say there's a job loss, you're displaced, anything happens financially, it can completely really wreck this house of cards and tear this strategy apart very, very fast. So guys, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.